It's Tuesday, and that means it's time for the Your Money segment. Joining me now is David Evans of Evans Financial. Thank you so much for being here.
Thank you.
So today we're talking about diversification. What exactly is that?
Correct. Diversification is, we'll call it not putting all your eggs in one basket. How about that?
Okay.
So it's when you're doing investing, you're not necessarily buying all stocks or all bonds or even different kinds of stocks and different kinds of bonds. So you kind of spread your investment portfolio out, and that's really important for a couple of reasons. One is people are living longer, and it's important that you don't. One of the biggest fears that people have in retirement is running out of money. So we don't have more life than we have money. So you have to be sensitive to that, and you have to build your portfolio in such a way. And diversification has been around since the beginning of investing, and most people agree that it's wise to do that. But not everybody realizes why it's wise. So ideally, if we can stretch your investments out to last as long as you do, that's important. The second thing is when you have diversification and you're investing in different asset classes, typically you are minimizing risk.
Okay.
And that's important. And you can even move around. But I have I've had people say, well, I'm diversified and I have this growth fund and this growth fund and this growth, and I look at them, and those growth funds are all buying the exact same stocks. So they weren't really diversified.
Gotcha.
They just had three different funds or three different named funds. But ideally, if you're diversified in different asset classes, you're spreading your monies out in ways that do you the best good. So it's minimizing risk, having your money stretch out for as long as you need to, and in an ideal world, you should be able to minimize taxes as well.
Okay.
And by that I mean, if you're investing, and early on, you're investing in maybe tax-free type things like Roth IRA,
Right.
or if your 401k has a Roth option, then you would invest in that, because as that money grows, it grows income tax-free, and when it comes out, it's income tax-free. And
Which is always a good thing.
that gives you obviously more money to play with when you are in retirement, so you don't have to settle up with the tax man as the monies that you're living on come in tax-free. And
Okay.
tax-free is always better.
Exactly. And is there an ideal number that we should shoot for when thinking of how many different ways to diversify?
An ideal number?
Of like different funds or?
No, but and early on, there's a statistic of 60-40. Meaning early on, meaning I'm going to say your age.
Right.
They say, okay, I'll put 60% of my assets into the stock type portfolios, but even different classes of stock, and 40% into bond or income type portfolios. Generally, though, the closer you get to retirement or in retirement, that blend mixes and changes, so it's more on the safe side, and it may be 20% into stock and 80% into safer investments that are income related or bonds or whatever that don't have as much fluctuation. So it's not necessarily a number as much as it is maybe a formula that you gradually manage over time as you get closer to that magical time called retirement.
Okay, awesome. Is there anything else people need to know about diversifying before we run out of time?
No, I just think they should be contacting their financial advisor, and that person should be able to help them. If they're not, then maybe they need to seek a second opinion. And I'm not even saying that with us, but just to seek a second opinion with someone, so that to take a look at their portfolio. And if you were going to have surgery, you'd say, this is major surgery, I'm going to get a second opinion.
Oh, definitely.
It's the same type thing with your investments.
Awesome. Well, again, thank you so much for taking the time to come on and speak with us today.
Thank you very much.
And if you want to learn more, just head to our website, ktbs.com.